Hi there, I'm Fabi and this is The Next Big Rush, and today I want to quickly touch upon a very important subject. If you ignore this one thing when you're investing in resource stocks, you might lose a lot of money or you might be holding the bag, as we say in investing. This is, I think, a silent killer. Most people don't really follow the companies that they have invested in on a day-to-day basis. And what happens is this one thing slowly kills your position in any specific company. What is it? It's dilution. So basically dilution is what it sounds like. When you have, for example, concentrated juice, you put in water, you dilute it, it gets weaker. In the context of shares, when you own a share, you own a little piece of a company. And what is very actually common for resource stocks is to issue more shares as they go along. Sometimes it's because they want to raise more money, and so they issue more shares and raise more money. Sometimes it's because they want to buy another project that they think is worth more than the shares that they're issuing. And you really have to keep an eye out for dilution, because at the end of the day, when a company has, say, 1 million shares outstanding, what they do is, if they want to now have 2 million shares outstanding, you have to think, okay, so now I own half of what I used to own because now they have doubled the shares. Do I own as much of the resource that they have as I did before? And this is something that has really opened my eyes, because I read an email by Marin Katusa, which is somebody we will be following very closely, and I'll tell you why in a minute. And it showed how a company can grow and can acquire projects and new forms of financing, but at the end of the day, you might be actually an owner of less and less and less resource of that company. So how does that happen? Well, basically you have to take the shares outstanding, quick word, shares outstanding and float. You'll see these two things when you study a company. The float is basically the shares available to buy and sell at any one point in the market. And the shares outstanding is all the shares. Some shares are sometimes private, or some shares have a holding period and they can't be traded until a certain period. So you really want to look at the shares outstanding, because they tell sometimes a future story. So it's really all the shares that exist for that company, whether they're tradable or not. Okay, so shares outstanding is what you want to look for. And out of those shares outstanding, you have to compare, okay, these shares outstanding represent how many, say if you're investing in gold, how many ounces of gold in the ground, okay? And when the company comes out with the news that they're buying a project, that they're raising money and issuing new shares, you have to take that new number and make a division calculation. Okay, so these new ounces of gold that they're buying, when you total it up, does it still mean that you will own as much gold in the ground as you did before, or will you own less? Will you own more? It really depends on your company's story. So one thing to look out for is look at your gold investments and see how many ounces in the ground does each one of your shares represent. If through financing and other shenanigans you realize that the amount of gold that each share has a claim to is going down, and that's a bad sign, because you're owning less and less and less gold and less and less and less value. That means that you need more and more buyers to come in and bid the price up of that one particular stock. The market cap of the company keeps growing, but at the same time it's growing because they're issuing more shares and not because your stock is going up. And obviously you want a company with a very tight share structure, because that raises your odds of having appreciation in your share price. Okay, Marin Katusa sent out an email with an actual example of a company, of a fictitious company that may have diluted their shareholders, and I want to go through that right now just to give you an example of how dangerous it can be to your investment when you think that the resources in the ground are growing, but really you're owning less and less of it. Super dangerous. It can kill your investment. So let's run through that example and see what lessons we can learn. Okay, in 2013, ABC Gold had 2 million shares outstanding. It had 1 ounce of gold reserves for every outstanding share. Okay. In 2014, ABC Gold issued 1.2 million new shares to buy new ounces in the ground. This gave it 3 million ounces in total and 3.2 million outstanding shares. That's 0.93 ounces of gold per share. In 2014, ABC Gold issued 1.5 million new shares to buy new ounces in the ground. This gave it 4 million ounces in total and 4.7 million outstanding shares. That's 0.85 ounces of gold per share. In 2015, ABC Gold issued 1.8 million new shares to buy new ounces in the ground. This gave it 5 million ounces in total and 6.5 million outstanding shares. That's 0.77 ounces of gold per share. You can see where this is going. The press releases sound great. ABC Gold is growing like a weed. The managers are getting big bonuses and slapping each other on the back. Newsletter writers say ABC Gold is experiencing solid growth, but this is not really creating any long-term value for shareholders, and you can see why. They've declined the actual ounces that you own from 1 ounce per share to 0.77. Okay, so this is a warning. This is a green email by Katusa Research, and then they go on to say how they've calculated all these ounces per share and a few of the companies that they recommend. This was free research published by Katusa Research. I highly recommend it, and I highly recommend you take an actual look into your particular ounces per share, because you might be losing out while the managers of your mining company might be making the big bucks. That's everything we have for today. Thanks for watching. If you like this, hit like and subscribe. Take care.